Hello, everyone, and welcome to today's masterclass. We're really glad you're here. My name is Del Clark, and I'm one of the founding partners here at Garda Wealth. And before we begin, just please note the information shared today is for educational purposes only and doesn't constitute legal, financial, or professional advice. Just need to say that. Um, I'm guessing you're here because you want your money to do more. You've worked hard, built savings, you're planning for retirement, and you're taking care of the people that you love. You just want to know that your money is working as hard for you as you did to earn it. So you're in the right place. Before we get started, I want to make sure you walk away with something valuable today, no matter what. And to that end, we put together a private family banking blueprint. It shows how people properly use an overfunded whole life insurance policy to fund investments, to create liquidity, and to keep more of what they built. So go ahead and scan the QR code on the screen, or if you'd like, you can enter the link that you see here to download it. Now, let me tell you what the next 45 minutes can do for you. Most families split their money into separate buckets, one for savings, perhaps another for college, one for 401ks or retirement, and whatever's left over becomes a legacy, right? Each account does one job and one job only, and each dollar gets used only once. Today, you're going to see a different approach. You're going to see how a properly structured life insurance policy can serve you and your family at 4 different stages of life. It can help you build savings. It can help fund college, create retirement income, and still leave a meaningful legacy. We actually call this the quadruple play. And what will happen is you'll see real numbers today, not just vague promises, but we're going to share honest caveats as well. Most presentations leave out. And later on in the presentation, there's a 5th play that we'll reveal. So we're excited for that. So that 5th play is basically the part that ties the whole strategy together. So again, stay with us till the end so you can hear that. Walking you through all of it today is my partner and co-founder, Ryan O'Shea, and our Chief Marketing Officer, Court Pitcher. Ryan has spent over 2 decades helping individuals, couples, and business owners design strategies built around their goals, as has Court. Ryan started as an investment advisor before becoming an independent planner, which lets him put his clients' interests first. Ryan lives this stuff. I see it. We're in the office together every day. And there's really, truly no one better to walk you through this. So with that, let me hand it over. Ryan and Court, it's all yours.
Well, thank you, Dale. We appreciate the kind introduction. We are really excited to share this valuable information with all of you today. In our last webinar, we talked about what we're doing in the macro planning method. We talked about estate and legacy planning. And one of the most powerful things that we can add to the overall plan is overfunded whole life insurance. It's an incredible asset that can do multiple things for you all throughout your lifetime. And in fact, I like to call it, I often refer to it as the Swiss Army knife of all financial products because it can do so many things. We also like to refer to it as the and asset. One of our good friends wrote a book about that, but it's about, because whole life can do this and this and this and this, so many great things it can do. And so Ryan is going to go through and talk about what we call the quadruple play and the phases of the quadruple play. And then, as Dale mentioned, you're going to want to stay on here because we're going to reveal that 5th play or that 5th phase. So what we're gonna go through on the quadruple play is how whole life can be a valuable asset for accumulation. We're going to talk about whole life, how it can be a tremendous asset for college funding, for retirement income, and for leaving a legacy. So we're going to cover each of these 4 areas. Once we get through that, we're going to reveal the fifth play.
Yeah, and excellent, Court. Yeah, I think we could just start walking through all of this for all of you. So
Yeah.
there's some numbers here, but I know everyone can read, so I'm going to explain them kind of in concept, but then I want you to understand how this can benefit you. So what we're doing is this is showing paying $12,000 a year. It's highlighted 180,000, and it's highlighted on the right 222,000 in cash at the end of that. Well, what we're going to do is show you how that accumulation phase, while you're putting your money in somewhere safe, protected against creditors, that sort of thing, and accumulating cash. It's like, okay, that's great. How do I use it? So, how do I use it? Well, there's a whole bunch of ways you can use it, which is why court calls it the Swiss Army knife or the and asset or it's all, well, that's cool. We all need to save money. Okay, how do I use it? So that's where we're using an example of, hey, here's how college funding works. And I actually have a story about this that's very personal. I've paid for both of my daughters' college doing this exact strategy. So, so what you can do is pull money out, and it comes out as a policy loan. There's two ways to take money from a policy, but we typically use a loan. So it's tax free. You pull it out, use it for college, and you actually never pay it back, even though it's a loan. It's just there, but you have enough money saved already in the policy that you don't need to pay it back. You could if you want. But that's kind of my personal story there, Court, that I've used it on. I'm sure you've had clients use it too for something like this.
Oh yeah. Yeah,
Yeah,
I mean, to me, this is the ideal instrument for college funding. In fact, we just had our first grandchild born back in January, and we just placed a whole life policy on her, and it was so fun to look at the illustration. We're going to fund about 6,000 a year into the policy. But once she gets to, age 18 or 19, when she's ready to go to college, there's going to be plenty of cash in there to be able to fund her college. And, as you said, Ryan, it's as simple as taking policy loans against the policy, and paying for college. It's all tax free because it's done in the form of policy loans, and then after that, the policy is just going to continue to grow with cash value. The death benefit will continue to grow, and that kind of leads into some of these other phases we're going to talk about here. But like you said, the cool thing about it is there's tremendous flexibility. She can take those loans and she doesn't have to pay them back ever, right?
correct.
Because it's collateralized against the death benefit. But if she wants to, if she has the means to do it, she can pay it back, which only gives her more advantages in the future. So
Yeah.
yeah, I think you and I have both had many experiences helping people do some cool planning like
Yeah.
this.
Yeah, this is a really awesome strategy, especially for folks like, congratulations on being a
Thank
grandfather,
you.
by the way. But
Thank you.
if you're trying to leave something behind that can truly change someone's life financially, this is an excellent way to do it. And we're going to walk through all the phases here. And when you see all the phases, everyone's going to see, wow, I could leave this to my kids,
Yeah,
and all I've done is pay for it for 15 years, and I never put another dollar in there ever again. That's the scenario we're running today.
awesome.
So the second phase in this, and we both have clients experiencing this as well, is, well, then what does it look like in the future with my policy? Well, there's the income phase, which these are also policy loans you can take. And I mean, I can talk through these numbers, but the basic premise here is you've spent $180,000, and then in retirement they are taking $1.6 million in policy loans at $75,000 a year. So now they've paid for college and they have a retirement income, all for something you've done for someone from in their childhood. It's awesome, you know.
Yeah,
And
I mean,
yeah,
oh, sorry,
no, no,
Ryan.
no, no. I was like, and it's also still protected, you know. which means you're giving your grandkids or something that is protected for them in their future.
Yeah, I mean, the thing I love about this is it's showing an example of taking $75,000 out per year, that's tax free. And
Mhm.
that may be in addition to other income sources that you may have in retirement, right? But it's just awesome that that's just additional tax-free income. The death benefit is also something that's another aspect that gives you the ability to spend and enjoy more of your other assets as well. We call that giving you permission to spend. But the cool thing about it is even if you spend down all the cash value, you're never going to fully you're not going to drain the death benefit completely. There's always going to be a death benefit, which leads to this phase.
Yep. Yep. And this is part of the quadruple play, right? And permission to spend, I love that. And then the other thing, permission to spend, because you're leaving a legacy no matter what, is, well, were you able to maybe take some risks in maybe a real estate investment or something that way, because you know all this is going to happen regardless. Like this income's going to happen.
Right, right.
So then you can take some more risks elsewhere in your life, um, or maybe be more certain that you can borrow money for a vacation home and have a mortgage, but know for sure you can pay that mortgage because of the guaranteed income that's going to come.
Absolutely.
So yeah, so this is kind of the numbers we talked about, but in general, um, I have so many clients that have done this on their children, grandchildren, even on themselves, where you can, because this doesn't just work for, in our scenario we're showing your grandkids, but this kind of works for everyone. But if you're past the college phase, it doesn't mean you can't build a policy like this. You're probably just not going to use it for college, unless you want to go to college in your later years, you know. But I have seen people completely utilize this to do a lot in their life.
Me too. It's pretty cool.
Yeah. Yeah. So let's look at a scenario where you don't actually do the college funding. So this is an interesting scenario here. We
Yes.
don't fund the college. Well, what if you did the same thing, but you get a scholarship or something? Well, now that same policy is paying you $150,000 a year in retirement.
Woo.
Exact same policy, but we just doubled the income without by not using the college. So whatever, maybe you get college loans, or maybe your parents pay for it, or you get a scholarship or something. We're doubling your income and not doubling the cost. It literally costs the same amount of money going into the policy. But now you're pulling 150,000, and look, you're still leaving a legacy. The death benefit is not going away. The death benefit
That
is not going away.
that is just so cool. It's so cool.
Yeah,
I,
yeah, it's interesting, and man, just think of leaving that to one of your kids or your grandkids.
yeah, absolutely.
So, um, so yeah, you want to maybe talk about the bonus, the fifth, I'll call it the quintuple play. You want to talk about the fifth one, the bonus?
Yes, happy to talk about that. So, um, to all of you that are on here and listening to this is stuff that we are doing ourselves in our own lives. I have multiple whole life policies on myself, my wife, my kids, and as I mentioned earlier, just started one on our first grandchild. And I know Dale has done the same and Ryan has done the same. But the fifth element that we're going to reveal here is that there's so many things that you can do with this cash value to build even more wealth, to acquire and acquire more assets and build more wealth. Um, you can take policy loans from the policy at any time for any reason. The ideal reason is to invest in other assets, other, especially like other cash flowing assets. We love to talk about real estate, and I know Dale owns properties, Ryan owns properties, I own properties. In fact, I just want to share an experience. A couple years ago, my sister is a real estate agent, and she came across a really cool development in Heber, Utah, which is near Park City, Utah. And there's just they're putting in a new ski resort there. They've got a lake that people can go and ski on. They've got beautiful golf courses. In fact, they're putting in a new Tiger Woods golf course there. So just an incredible location. And she found a development that they're building some, nice modern type cabins there. But it's one of the only areas in that area that is zoned for Airbnb. So my sister reached out to me and said, "Hey, I think we really need to look into this." And so we did. We started doing our due diligence, and and everything looked great. We decided, hey, this is something we need to capitalize on. We need to invest. And so we wanted to act. We needed to act quickly. We needed to get a down payment on the properties that we were buying. And so it was great. I simply contacted the insurance company that I have my policies with. I asked for a $75,000 loan. It was in my account within 2 days, and I was able to write a check and make a down payment on that property. And we're super excited about that. We haven't started building the cabin yet. We're going to do that probably here in the next year. And then we're going to rent it through Airbnb and VRBO so that it becomes a cash flowing asset for us. The other thing that we're really excited about is the 2034 Olympics that are coming to Salt Lake City. And so that was another reason we decided to jump on that and invest in that asset because, renting that out during the Olympics is going to be pretty cool.
Okay.
So that's an example of, how just ways that I've used my policy to acquire more assets. And it can be anything, not just real estate. It can be any other type of investments that you want to get into. And so, Ryan, you may have some additional examples as well.
Yeah, I have a real estate example I'll give, but I have a different one that has worked out really positively for a client. So I'm going to give my real estate 1 second, but I actually have a client who, rather than just because we have business ventures and all that, on that, speaking of cash flowing assets, they actually took policy loans not to fund them starting a business, but their child was trying to transition from being an HVAC tech to actually owning his own company. Well, mom and dad loaned him $100,000 from the policy, so similar to the number we showed on the college funding, and and but he's paid it back since then, 4 years in. But they weren't even going to ask for it back, but they utilized that to benefit their children to fund a business venture, which is because, I mean, think of a 22-year-old trying to go borrow $100,000. It's
Yeah.
so
Yeah. That
from a
would be
bank.
tough. Yes.
So instead, mom and dad utilized their policy for, speak of a funding opportunity, is actually funded their own child starting his own business. And I've watched that blossom over the last 5 years, and it's been awesome. He owns his own business, has kids now, all that, and now is making the money, not just to pay them back their $100,000, but is making money for himself and his family. And oh, by the way, guess what he did? Bought policies like this on all of his kids now that he's making the money.
Yeah.
You know, like mom and dad taught him well, like, hey, look what this did for you. You should do this for your kids too. You know, uh, so he's actually done that, which has been so awesome. Um, and then my real estate example, I'll keep this one kind of short, but it's a friend of mine who wanted to buy a property, a pretty expensive one, but it had been on the market for quite a long time. Um, and well, he went and made an offer, and rather than going and get a bank loan, he went and offered cash, but got a discount of $150,000 because he could close with cash and do it in a week rather than them having to wait on someone to get financing, all that, and get it all done. Well, $150,000 discount, got the
That,
property. Then
that's
we went,
amazing.
yeah, well, and then we went to the bank and got a bank loan and paid the money back to the policy. So we got a discount, got a property, and then was able to finance out of it and just pay back. And now he has more money in the bucket, right? Now the money's back in
Right.
life insurance and he can use it again for the next opportunity.
Right. That is so cool, Ryan. Those stories are awesome. I love hearing these kind of stories. I think one of the things that I've found at times throughout my career is sometimes people get so focused on what kind of growth or rate of return am I getting inside this policy? And because it's safe and it's protected and guaranteed, it's not going to get huge, enormous returns like you could get in other investments, right? And so people kind of get hung up on, well, this is only growing at what, like 4, 5, 6% with interest and dividends. It's just good, slow, steady growth over the years, compounded growth, right? But I always help, from there, if I can tell they're getting hung up on that, I'm like, hey, that's not the point here. The
Mhm.
point is this is a great place to where you can get all these benefits. Get your dollar doing more than one thing for you,
Mhm.
and it gives you the point of it is it gets you access to capital quickly, tax-free capital
Mhm.
that you can then take and invest into other things that can generate greater returns, right? So I'm like, more of the wealth building happens outside of the policy. It's just the policy is is that instrument that helps make it all work. It's kind of the heartbeat of the whole thing, right?
Yep, yep. That's I heartbeat is what the word you use for it. I actually call this the center of my financial universe. It's and it's because of and one of our when someone we knew very long ago called it the economic value of certainty. Like
Yes.
like
Yes.
the fact that it's predictable and you know exactly what's going to be there and when it's going to be there and that it's available allows you to go take some risks outside of this because you have the center of your financial universe that's just going to be predictable and just do what it does. It's just does what it does.
That's right. Yes. I love that. And I mean, um, the thing about it is when you really, we all know people who are wealthy and you know maybe many people on here are in great positions. And so, but it's hard to get wealthy if you don't have access to capital or cash, right? It's hard to capitalize on an opportunity when it comes around if you don't have access to cash or capital. And that's the whole point of what this can do for you.
Yeah, yeah, I love it. I love it, and it's really just a way to kind of make your your financial world to come together and
Mhm.
and at Garda here we have the macro planning method which we discussed on our last webinar. Yeah, but it's this is one of those pieces, right? You still need a CPA, you still need, there are the other things that need to be there, but
Right.
this gets to be like the engine that's driving the car, you know?
Yes. 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 And not only the engine, it becomes like a turbo booster for everything else.
Yep. 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 So awesome. I just want to remind everyone to kind of stick around after this. We are going to do a question and answer session as well, where if there are specific things you're wondering about, Court and I are happy to answer answer questions that are specific. Obviously, we're not going to mention your name, but that are specific to situations for people.
Well, this was great. Good. Thanks for sharing all these great things, Ryan.
Yeah, you too, Court. It's been
Yeah,
great.
thanks, Ryan and Court. This is fantastic. I've watched these guys walk through this quadruple play strategy before. I've heard Ryan do it on several occasions. I've done it myself, and it still gets me every time. What you just saw is something most people never get to see laid out that plainly. And in fact, the first time I saw this quadruple play, I was really so blown away that I started policies on all four of my young kids. We're now into a phase where we have six grandkids, and we've got three of the six knocked out already, with three more to go. I had my daughter calling my adult children and saying, "Hey, we got three more to go. So are you willing to move forward?" And all of them said yes. I've also set up the strategy for thousands of my clients, and the gift that you can give with this is so powerful. I call it, it's truly a gift of a lifetime, or a gift that keeps on giving. But here's the thing, though. What you saw today was built on example numbers. The real question is what it looks like with yours. And that's really the part that actually matters. And that's why we put together a private family banking strategy session that we'd like to share with you all. It's a simple one-on-one conversation that'll help you see what the strategy would actually look like for your family. And when you schedule, you'll be speaking directly with one of us, either Ryan, who just walked you through everything today, or myself, Del Clark. I'm his partner and co-founder. Ryan and I work with these strategies every single day, and we'll walk through it at a pace and answer every question so you leave with clarity instead of uncertainty. And we'll give you actual numbers that apply to your situation. So at this point, if you're thinking, I want to see what this looks like for me, here's your next step. Go ahead and scan the QR code on the screen, or you can enter the URL that you see here to schedule your private family banking strategy session. And here's what you'll get during that conversation. Firstly, you'll get a clear picture of what a properly structured policy would look like for your situation with your numbers. Secondly, an understanding of how these four phases apply to your specific goals, whether it's for you or maybe you have children or grandchildren, what it would look like in their situation. Thirdly, we'll look at the fifth play. So this is we call it the quadruple play, but really it's a quintuple play, where we talk about your family's opportunity fund and how this could work for you on your own, basically as your own source of liquidity. And finally, and probably just as importantly, you'll see how this fits into your broader financial plan so nothing is left disconnected. So again, you can scan the QR code now or type in the link on your screen to schedule. It doesn't need to be difficult. There's really no pressure, no obligation to move forward. It's just simply a conversation about what's possible for your family. And if you're not quite ready to schedule a conversation yet, that's totally okay. You can also scan the QR code or use the link on the screen to download our private family banking blueprint. And what that does is it shows how families use this kind of a policy to fund investments, create liquidity, and keep more of what they build inside the family. And it's just really a simple way to keep exploring the strategy until you're ready to take that next step. So again, thank you everyone for joining us on this webinar. We're going to pause for a second, and then we're going to open it up to Q&A. So if you have any questions, please go ahead and type it in the Zoom workplace, and we'll jump into that here just shortly. All right, guys. Why don't we just dive in here? The first question that I see on here this is from, I actually won't say their name. How would one of these be set up if there is a one-time lump sum of money, say $100,000?
Oh, that's a great question. So,
Great.
yeah, there are a couple ways to do that. So, The one-time lump sum payment would make it what's called a modified endowment contract or a MEC. So we wouldn't want to immediately do that, or it would get rid of some of those tax benefits we spoke about. But there are two things that come to mind for me here. You take the $100,000, we purchase an immediate annuity that pays all the premiums over 7 years, and then all the money is in there and just does exactly what we have shown here, and it will just grow over time. So that's one option. There are also companies that have what's called a premium deposit fund, where you can put the $100,000 in there, and then they just and they pay you interest on it in the meantime, by the way, and then they just automatically pull the premiums over several years to get it inside there, but avoid the tax consequences of what's called a modified endowment contract or a MEC. Anything else on that, Court, or did I cover that okay?
No, I think you covered that great. The point, I think the main point there is just probably not ideal to dump it all in as one single premium, because it can create that modified endowment contract, which makes the cash value and stuff taxable, and kind of defeats the whole point of what we're talking about here. Because one of the best things about whole life insurance is all the tax-free benefits that it provides. So the two options that you suggested here, I think those are the exact two I would have given as well. So
Awesome. Awesome.
All right, guys, thank you. We have another question here. What if I were to use the money for home improvements?
can I answer that one?
Yeah, I was
it.
going to say, you want that one, Court?
Yeah. I think this is perfect because my wife and I did a remodel. We pretty much remodeled our entire home last year. And so we actually utilized our policies to pay for that. We didn't want to go finance it at the bank or anything. We just want to be able to pay cash, and because our policies function as our private family banks, we were able to get that cash, pay for our remodel, and then pay ourselves back essentially. So yeah, that's something that's totally something you can do.
Yeah. Well, and Court, to add to that, you probably got a discount from whoever your contractors were, because you didn't have to finance it and
That's right.
could just cut them a check and be like, here's all the money, get it done,
That's right.
which
Yeah,
makes a difference.
anytime you can come to the table with cash, it always gives you a little more leverage when you negotiate. So yes, that helped a lot for sure.
Yeah. It helps on price, but it also might move you up in the line as far as the wait list on
Yes.
getting the work done too. Cash
Right.
talks,
Yeah, it does. It talks for sure.
All right, we have a third question that just came in. Actually, a couple more that came in while we were going through that. The next question is, I'm 58 years old. What would be the best way for me to get started to use this for retirement?
So typically what we would do there, and by the way, I turned 50 this year. Yeah, it's definitely not too late to utilize this for retirement. Usually what we would want to do though is kind of maximize what we call the overfunding or paid up additions, PUAs. Every company has a different name for that type of rider, but that's how we structure policies. You're not just paying for the insurance, we're actually putting extra cash into the policies, which that's kind of the Court called it the turbo. I'll call it the supercharger. That's the supercharger of the policy. And you just need to have an agent that's willing to make about 1/3 of the commission that they were going to make, because the extra money's not really what we get paid, paid on. That's how we structure them. So there's always early cash value. So having cash value early, that's actually kind of the most important way for these policies to kind of be whatever you want to call it, your financial engine. I call it the center of my financial universe. I can't remember what you called it, Court, but it's like that's the best way to do it, is to make sure you're overfunding them, and to a pretty good degree. So at least half the money you're spending it's not paying for the insurance. It's going to cash, and then that cash grows.
So just to add to that, this is a great question, because some people have a perception that once they get into their 50s or 60s or whatever, that it might not work, but it actually can, and it does. Part of our job as financial consultants is to help you, is to look at your whole financial picture. Okay, take a holistic or a macro approach, which we talk about all the time, and help you find the money.
Mhm.
Okay, help you find a way to make the strategy work in its ideal way for you. So that might be helping you, mitigate taxes. It might be looking at your other retirement accounts and assets and finding ways to, do things with those. But our part of our job is to help you find the money so that you can comfortably fund a policy. If you're 58 years old now and you're planning to retire within the next 5, 7, 10 years, we can help you find that money to make that work for you.
Yeah, the other thing I would add on that, Court, is the cash flow part. Dale, my business partner,
Yeah. Cash.
that was part of his start in the industry was something he calls the cash flow index. But basically, are your debts not just are your taxes structured properly? Are your other investments working well? Hey, if the debts aren't structured properly, well, let's prioritize what gets paid and what gets paid off, and then you suddenly might free up cash flow every single month, and then we can put that towards these type of structures, properly structured policies.
Yes, absolutely. Agreed.
Great, great. Thank you for your answers. We have another question here. How do you determine the best time to add another policy on yourself?
You want me to take that one, Ryan?
Yeah, yeah. Go ahead, Court. Go ahead.
Okay. So again, I think the best way to answer that is, scheduling a consultation with one of our team members, and just to give us the ability to kind of get a snapshot of your whole financial picture, your whole situation, can help us discover, we were just talking about your cash flow, right? Cash flow is really what helps determine the timing in adding another policy. So if we can get a sense of what your cash flow is like, or we can help you create more cash flow, in other words, help you find more money, then that'll help determine when is the best time to add another policy on yourself.
Yeah,
But
yeah.
the other answer is the sooner the better.
I agree with you on that one, Court. And then what I would add to this, you actually gave an example of this today, is um, income changes, but also life changes. You just had a
Yeah.
grandchild. You just had a grandchild, or if you have a new child, or if you get married and then have a child, like life changes also is the time. Income, cash flow, and I'd say life changes. I end up doing a ton of additional policies for people who really, they're like, well, I have 3 kids now, and it's like, well, that's a great time to look at it. You should always be looking at your financial picture, but life changes. That's a great time to have a conversation about, hey, am I optimized? Do I need more, or do I want some on my children? I have a new child. That's the great time to get a new policy, just like you're doing on your grandchild. But yeah, I'd add life changes to that too, because everyone has those.
Mhm.
Absolutely. Yeah.
All right. And we just barely had another question come in. So if you guys are ready for that, um, if you don't want to have a loan and just want the money outright, what is the scenario for this? Example, taxes, fees.
You want to take that one, Court, since the tax part of it?
Sure. Yeah, so if you don't want to take a loan, you don't have to. You can just you can just fund money into your policy and let it grow and compound over the years. And then once you get, to retirement, as we showed you in one of the retirement examples, you can then utilize the cash value and turn this into an additional income stream for you in retirement. And the nice thing about it is it's completely tax-free income. So that's one thing that we're focusing a lot on with our clients right now because we feel like with the amount of debt that our country is in, and along with other issues, that at some point taxes are going to go up. We don't know when, and we don't know how bad it's going to be, but one of the conversations that we're having, we're literally screaming from the rooftops actually, is how can we help our clients get more money into tax-free instruments such as whole life insurance? Because the more that you can accumulate in tax-free instruments, then when you go to retire, if tax rates have gone up, the effect's not gonna be as negative in your situation if you have money in tax-free instruments. So
Yeah.
as far as fees go, with whole life insurance, there's no fees. There's just a cost of insurance. But the way that we've all been trained to design these policies is to get the death benefit as low as we can and maximize the cash accumulation so that it minimizes the cost of insurance, and that cost of insurance is pretty much gone and paid for in a very short period of time. That way, it's just a true cash asset that's accumulating and compounding over time. So,
Great. Well, and let me help clarify the question, Cord and Ryan, because this lady is asking, I think, about withdrawals. Like, if she doesn't want to take out a loan, what does a withdrawal look like? Is that a viable solution if she wanted to use it for that kind of a purpose?
yeah, why don't you take that, Ryan?
Yeah, yeah. So life insurance in general is what we call FIFO, first in, first out. So you can take you can take withdrawals without taking a policy loan. And the way it would come out is first money in is what you take out. So the money you're taking that you've put in up until your cost basis, up until how much you've paid in, that's all tax free. After that, it's all gains, and gains would be taxable if you do a withdrawal rather than a loan. Usually, though, by the time you get that far into a policy, I've very rarely had people elect to actually take a withdrawal versus a policy loan because the cash is growing by such a great number that the loan just makes more mathematical sense. It just makes more like the having it all be tax free. Or I've had people who this is one strategy you can do is where you do withdrawals all the way through your cost basis. So that's all tax free. And then you flip the switch and start taking loans against your gains. So then you've kept it all tax free. That's an option. It's kind of complex, but we can definitely do that.
Love it. Great. Yeah, perfect. And I think that's the end of the questions that we have. Does anyone else have any other questions they want to throw out there before we finish things up today? Or, while we're asking that, Ryan and Court, do you have any other final comments that you'd like to share with everyone?
Oh, I'd just like to thank everyone for attending and asking really good questions. And we're always here to answer these questions, especially if there are sometimes people don't want to ask certain questions in public because it's way more about their personal situation. So I would just encourage you to get on the private family banking session or something like that, and just know that your privacy is of the highest priority to us. But I just wanted to thank everyone for coming. I love this concept. It gets me up in the morning and makes me smile that I get to come to work and do this.
Yeah, I echo what you just said, Ryan. Ditto to everything. Thank you for everyone that attended today. We hope you got a lot out of this. This is one of my favorite topic as well. It is one of our favorite, all three of our favorite topics. So thanks for being on here. We hope you got a lot of value out of it. I'm just going to end with kind of a teaser for our next webinar. We talked about part of our job is helping you find the money and create more cash flow. And our next webinar is going to be how to help you legally and ethically and legitimately mitigate taxes. And the more that we can help you save in taxes, that's just more money that we can help you fund into things like this, and other opportunities as well. So we're excited for that next webinar and hope you'll all join us for that.
Wonderful. Thank you, Ryan and Court. Again, it's been a pleasure being here with you all. And until next time, have a great day.